Okay, let's talk about that shock. You watched it happen, right?
Uh-huh.
Gold dropping nearly $300 in just one session. Absolutely frantic.
And silver wasn't spared either, losing almost $4.
Exactly. The headlines, they were just instantaneous. Screaming panic. The big question, is the gold bull market actually dead?
Yeah, Wall Street seemed ready to write the obituary, didn't they? Claiming, the volatility finally killed the momentum after that historic run.
It was genuinely one of the wildest days we've seen this decade for precious metals.
No doubt. We saw gold briefly dip, nearly $280 on the low. Then it clawed back a bit, settled above $4,100 an ounce.
And silver?
Silver touched almost $55, which was incredible. Then, bam, slammed right back down to around $48.
So the initial reaction, if you were just watching the mainstream channels, was pretty clear.
Oh, yeah. Panic. Get out. Sell everything. That was the message.
But here's where it gets really interesting. The twist. Peter Schiff, the famed economist, he looks at this huge sell-off, this spike in fear.
And he doesn't see a crash. Not a failure.
No, he sees something, well, way more significant. He's calling it the ignition point for a whole new global monetary era.
Right. He argues this pullback, as deep as it was, isn't weakness at all. It's almost like a calculated gift.
A gift for people who understand the tectonic plates shifting underneath the global financial system right now.
So that's our mission today. We're going to try and synthesize Schiff's, let's be honest, pretty explosive analysis.
We'll break down exactly what he wants every serious investor to get their head around right now.
Like why he thinks $4,000 isn't just a number, it's the new solid floor.
Why this crazy volatility actually signals strengths, not collapse.
And maybe most importantly, this huge accelerating de-dollarization happening globally. That's the real engine he sees behind these prices. This goes way beyond just trading commodities.
Absolutely. And look, if you value this kind of essential, maybe contrarian analysis, and you want our team digging into these complex stories for you,
synthesizing all these different perspectives,
make sure you hit that subscribe or follow button right now. It really helps us keep bringing you this stuff. We check out dozens of sources so you're always informed.
Okay, so let's dig into the actual price action first. A 6, maybe 6.5% drop in one day. That is huge. No denying it.
Huge. But Schiff says you have to apply the context, right?
Exactly. Crucial context. Even after this historic plunge, this so-called crash, gold was still trading above $4,000.
Wait, hang on. That $4,000 level, wasn't that like a record high just the week before?
Precisely. The price where it settled after the crash would have been a massive all-time record just days earlier.
So the word crash, it's completely misleading then if it just fell back to recent record highs.
That's his point entirely. The market basically retraced to a level it had just established as a record ceiling.
Okay, but then why the panic? Why the drama? This is where Schiff brings in the psychology, doesn't he?
Right. His core thesis gets pretty controversial here. He argues this specific dramatic drop wasn't accidental. It was orchestrated, a psychological attack.
Designed to do what?
Inflict maximum pain, maximum fear on the psyche of anyone thinking about buying. Scare them out, convince them the move is over.
Right before it potentially explodes higher, towards his $5,000 target and beyond.
That's the idea. Scare out the weak hands before the next major leg up.
Orchestrated is a strong word. We definitely need to circle back to who he thinks benefits from that.
Yeah.
But let's stick with the price levels for a sec. If this is just a shakeout,
A necessary correction.
what are the new numbers? What levels does he say are now cemented as real support?
He's incredibly adamant about gold holding $4,000, calls it like a champ.
Okay.
He believes $4,000 is fundamentally the new $3,000. And the reason this is key is because real serious money is now in the market.
Define real serious money. What does that mean practically?
Not just retail jumping in and out. He's talking large institutional capital, maybe sovereign wealth funds. Central bank buying. Forces big enough and committed enough to actually defend that level.
Right. If it's central banks swapping dollars for gold, that's a whole different ballgame than just algorithms trading futures.
Completely different.
So if $4,000 is the floor, where's the buying opportunity, according to Schiff? Does he say, wait for a dip below?
His advice is really clear on this. Any brief trade below $4,000, he sees that as an extraordinary, great buying opportunity, like a gift.
But don't wait for the perfect entry.
No, he cautions against that. He says things are moving too fast globally. $4,125, where it settled, is close enough to the floor. If you're serious about getting physical metal, you should just be accumulating during this sell-off. Don't try to time the absolute bottom tick.
Okay, let's shift to silver then. Always the the wilder sibling, right? Smaller market, more retail speculation.
Definitely.
So if gold held its key floor like a champ, why couldn't silver hold $50? It got hit much harder percentage-wise.
Yeah, silver had a much more dramatic shakeout. Couldn't hold $50, fell back near $48. Schiff basically says this just proves his point about speculative noise versus fundamental strength.
How so?
He insists $50 is not resistance anymore. The market just proved it could hit almost $55 right before the drop. So the potential is there.
So the drop back to $48 is just...
burning off the weak hands, flushing out the leveraged retail positions. He sees it as just clearing the decks, setting the stage for the next breakout attempt.
And his advice for silver buyers?
Emphatic. If you felt like you missed that run above $50, this pullback is your second chance, maybe your last chance before the next major move higher.
Okay, let's go back to that idea of manipulation, because that's really the most incendiary part of his whole analysis here.
It is controversial, yeah.
If the bull market is fundamentally strong, driven by things like central bank buying, who are these powers that be he talks about? Who benefits from creating this sudden fear spike?
Well, Schiff points fingers pretty directly. He argues mainstream media, the big Wall Street banks, anyone heavily invested in keeping the current dollar system going,
Right.
they need to discourage people from buying physical metal.
Why? What's the motive?
They don't want capital fleeing paper assets for hard assets. They want you to believe gold is too risky, too volatile. They'll label it a wild commodity or scream the bull is over, precisely when it's actually gaining serious traction.
So this whole psychological game, this media narrative, it kicks in because demand, maybe institutional and even public demand, is actually picking up.
Exactly. They saw gold hitting new records, getting more media buzz.
And they had to bring out the big guns in terms of negative sentiment and maybe even selling pressure.
That's precisely his argument. Generate scary headlines, trigger stop losses, shake confidence. Anything to keep the average investor out of physical gold and silver.
Keep them in the existing system.
Right. Maintain the narrative that paper is safe, the dollar is supreme.
Yeah.
But Schiff offers this really important paradox for investors.
What's that?
Bull markets rarely end on fear. They often feed on it. This huge volatility, the negative press. He sees it as proof the underlying rally is getting stronger. It's forcing the old guard, the resistance, to use bigger and bigger tactics to try and hold the line.
Wow. Okay, if you're finding this breakdown valuable and you appreciate us bringing you these sometimes challenging perspectives,
Synthesizing views you might not hear elsewhere.
please just take a quick second, hit that follow or subscribe button. It genuinely helps us keep doing this deep analysis.
Okay, so let's step back from the day-to-day price swings for a moment, because the real significance, according to Schiff, is macroeconomic. It's the big picture.
He connects this volatility to something much bigger than just a normal market cycle.
Much bigger. He draws a direct parallel to 1971 and 1972. Crucially, not 1979 or 1980.
Why is that distinction important? 1980 was the peak of the last big gold bull market, right?
It was. But 1971-72 was when the monetary system itself fundamentally reset. He's saying this is like that. This isn't a market peak within the existing system. It's the system itself beginning to change. A monetary reset is underway.
Okay, the 1971 moment, that's a huge historical marker. Can you quickly remind listeners what actually happened then? Why does it matter so much today?
Sure. 1971 was when President Nixon unilaterally closed the gold window. He basically severed the last link, the direct convertibility of U.S. dollars into gold for foreign central banks.
Right, ending the Bretton Woods system.
Exactly. That move completed the transition to the purely fiat, unbacked global currency system we've had ever since, with the dollar at the center. Schiff argues today we're seeing the reverse of that. The fiat system is failing, and central banks are initiating the reset back towards hard assets.
And how does he say this de-dollarization, this move away from the dollar, is actually playing out now? What's the evidence?
He points to, overwhelming evidence that central banks, especially outside the West, think BRICS nations, other emerging economies, they are quietly but very rapidly dumping their U.S. Treasury paper reserves.
Selling their U.S. government bonds.
Yes. And instead of holding dollars, they're aggressively buying physical gold, stacking it. This is them actively de-dollarizing, preparing for a world where the U.S. dollar isn't the sole dominant reserve currency anymore.
That implies a massive shift in global power.
Yeah.
This time, it's not the U.S. dictating terms.
No, it's the rest of the world reacting to decades of U.S. policy, like massive debt and currency printing. Schiff actually calls this a kind of financial liberation day for many nations.
Liberation. How so?
For decades, they basically subsidized the U.S. economy. They took fiat dollars for their real goods, then recycled those dollars back into U.S. debt, funding our deficits. He argues they allowed Americans to live well beyond their means.
And now?
Now they're looking out for themselves. The cost of everything imported skyrockets. Inflation becomes chronic, not transitory. The ability to just print money to solve problems without immediate harsh consequences, that ends. He uses the phrase, the rug is being pulled out from under us. And this gold price action is one of the loudest signals that this shift is happening now.
Okay, so the massive elephant in the room for the last decade, Bitcoin. What does this whole monetary revolution, this potential return to gold, mean for digital gold?
Schiff, as you might expect, is exceptionally blunt on this. He argues Bitcoin and that whole digital gold narrative, it really only flourished during what he calls gold's 13-year nap.
Meaning that long period, roughly 2011 to early 2024, where gold prices basically went sideways.
Exactly. Gold wasn't giving those huge returns. Retail investors got frustrated. They bought into the marketing hype around Bitcoin being gold 2.0, the faster digital alternative.
But now that gold, or real money, as he calls it, is decisively waking up, moving past that long consolidation.
He believes that dynamic totally reverses. He argues gold's powerful resurgence is actually the pin that can pop the Bitcoin bubble.
The pinprick theory. What's his evidence for that?
He points to something critical. Bitcoin hasn't really been rallying strongly with gold recently, even with all the ETF hype and institutional money supposedly flowing in.
That's true. The correlation hasn't been tight lately.
Right. If Bitcoin were truly digital gold, a reliable safe haven, Schiff contends it should be performing much better alongside physical metal right now. Its failure to do so, he says, is a significant warning, a huge red flag, that the narrative is fundamentally flawed.
And then there's his final warning about liquidity, who might be the ultimate sucker in the crypto market. That's pretty provocative.
Very. He basically suggests that a lot of the smart money, maybe even some institutions that launched ETFs, they created the hype not because they believe in it long term.
But to do what?
To create exit liquidity for themselves. He essentially warns individual investors. If you own Bitcoin and you're not selling into this hype, you might be the liquidity for the people who are selling.
Ouch. So they pump it up so they can get out.
That's his provocative take. Keep the retail crowd buying the dream, while the insiders quietly cash out before the market potentially re-rates physical assets way above digital promises.
Okay, that's definitely a stark alternative view. Let's try and quickly summarize Schiff's whole interpretation of this recent crash, though.
Bottom line from Schiff. The $4,000 floor in gold is solid, likely held by serious players.
The volatility, even that huge drop, is just noise. A necessary shakeout of speculators, not a fundamental break.
And the real driver is massive. Central banks de-dollarizing, signaling a global monetary reset like 1971, not 1980.
So his core message is, buy the fear. Use this volatility.
Yeah, the takeaway is don't get distracted by the daily noise. The fundamental reality is the world is shifting away from paper promises back towards tangible wealth. Gold holding firm above $4,100 after that massive selling attempt just confirms that underlying strength for him.
And why should you, the listener, care? Well, this isn't just academic chat about prices. It's potentially about a global revolution, hitting currency stability, your country's financial standing, and ultimately the real value, the purchasing power of every dollar you hold.
So here's the final thought we want to leave you with today, building on Schiff's analysis. If central banks, arguably the smartest money on the planet, are genuinely preparing for a world less reliant on the US dollar, maybe even returning to some form of gold backing,
then what is the true long-term value of any asset that isn't physical, tangible money, whether that's stocks, bonds, or digital tokens, especially when the dollar might lose that unique reserve status?
And maybe more personally, how do you position yourself to hedge against what could be a serious long-term erosion of fiat currency value?
That really is the multi-trillion-dollar question. Yeah. If you want more analysis like this, insights that challenge the mainstream consensus.
Make sure you are subscribed or following the show. Hit that button right now so you never miss our next deep analysis.
Thanks for tuning in.